Picture this. You walk into an office in Mayfair, 46 Hertford Street, one of the most expensive postcodes in London, and the walls are covered in signed boxing gloves. I'm talking Mike Tyson, Tyson Fury, Anthony Joshua. There's an Olympic torch on the shelf, signed Pink Floyd albums, football shirts, Messi, Benzema, and one old Argentinian shirt that just says Diego. This is not a gallery. This is not a museum. This is the office of a lending company. A company that had borrowed £2.5 billion from some of the biggest banks and private credit funds on the planet. And when the insolvency officials arrived, the walls had been stripped, the Tyson gloves gone, the Pink Floyd albums gone, the Diego shirt gone, the CEO also gone, allegedly to Dubai, with a worldwide asset freeze and a travel ban chasing after him. £2.5 billion borrowed from Barclays, Apollo, Santander, Wells Fargo, Jefferies, a £930 million hole where the collateral was supposed to be, and fraud allegations in open court. And the question haunting the Bank of England, the FCA, and every major lending institution in the city right now is not just how did this happen, it's who was supposed to be watching. Today, we're going into shadow banking system, what it is, how it grew, why it got so big, who operates inside it, and the story of a Mayfair lending company that, according to its accusers, may have pulled off one of the most brazen alleged frauds in the modern British financial system. This is shadow banking. Before we get into MFS, I need to give you the framework, because this story only really makes sense once you understand the world it happened in. So, banks, traditional banks, Barclays, HSBC, NatWest, Lloyds, you know them. You probably have an account with one of them, and they're heavily regulated. So after 2008, when the entire global banking system nearly collapsed, regulators basically said, never again. Banks now have to hold capital cushions. They have to pass stress tests. They have to report exposures. The Bank of England's prudential watchdog can walk in and demand to see the books. There are rules on how much they can lend, to whom, and under what conditions. Think of it like a restaurant with a full health inspection. The kitchen is open, the hygiene rating is on the door, and if something goes badly wrong, somebody official is supposed to be checking. Shadow banking is financial activity that performs similar functions to traditional banking, lending, borrowing, pooling risk, maturity transformation, but outside the core regulated banking system. Includes private credit funds, bridging lenders, hedge funds, money market funds, mortgage vehicles, and other non-bank lenders. Often faster, more flexible, and less constrained than banks, but also less scrutinized. So shadow banking is everything else. It's the lending that happens outside the traditional banking system. Firms that lend money, raise money, pool risk, fund assets, but aren't banks. They don't have a banking license, they don't take ordinary customer deposits, and crucially, they are not regulated the same way. Going back to the restaurant analogy, shadow banking is the chef who set up a summer club out the back. The food might be excellent, maybe even better. They can move faster, take more risk, be more creative, but there's no hygiene rating on the door. And if something goes wrong in that kitchen, you may not find out until everyone's already been served. Shadow banking includes private credit funds, the Apollos, the Ares, the Oak Trees we talked about in episode 1, hedge funds, money market funds, mortgage investment vehicles, and yes, specialist property lenders like MFS. How big is this world? Huge. The Financial Stability Board estimates the global shadow banking sector at somewhere between $100 and $200 trillion. That is not a niche side hustle of the financial system. That is an entire parallel world. And depending on how you measure it, it may already be bigger than the regulated banking system itself. And here's the irony, a beautiful, slightly tragic irony. Shadow banking exploded because of the 2008 crash. So after 2008, regulators cracked down hard on banks. Capital rules got tighter, compliance got more expensive. It became harder for banks to lend to certain types of borrowers, especially borrowers who needed money fast, flexible, or a bit outside of the neat boxes of a traditional mortgage application. So a gap opened up, and nature hates a gap. Finance especially hates a gap. Borrowers who needed quick bridging finance, property developers chasing time-sensitive deals, businesses that didn't fit a standard risk model, they started going to non-bank lenders instead. At the same time, investors were starving for yield. Interest rates had been crushed, government bonds were paying next to nothing, and these specialist lenders, these private credit funds, these non-bank vehicles were offering 8, 10, 12%. So money flooded in. The shadow banking sector ballooned, and for a long time, it mostly worked until it didn't. Bridging loan is a short-term, high-interest loan used to bridge a funding gap, often between buying a property and arranging longer-term finance or selling another asset. It's fast, flexible, and expensive, usually secured against property, typically last weeks to months. So what did MFS actually do? They were a bridging lender, which sounds deeply boring, so let me try and make it a bit interesting. You know how buying and selling property in the UK is absolute chaos. Everything is in a chain. Deals take months, people vanish, surveys throw up nonsense, and everything falls apart on day 90 for reasons that nobody can quite explain. Now imagine you're a property developer. You found the perfect derelict pub in Hackney and you want to turn it into flats, you little gentrifier. The seller wants to complete in 3 weeks. A normal bank mortgage will take 3 months and you're going to lose the deal. That's where a bridging lender comes in. They say, fine, we'll lend you the money in 72 hours. You buy the pub, you develop it, you refinance the sell, you pay us back with interest. Quite a lot of interest. 12, 15, even 18% annualized in some cases. Short term, expensive, secured against the property. If you don't repay, we take the building. Now, for a long time, this was a niche, but basically sensible market. You had local lenders, relatively modest amounts, carefully managed, but then it got bigger. And when this kind of market gets bigger, banks start turning up. Warehouse lending is a revolving credit line that a bank or institution provides to a non-bank lender to fund loans. The lender originates the loan, pulls them into a warehouse structure and repays the facility as loans mature, refinance, or are sold on. If the underlying loans are weak, fraudulent, or overvalued, the bank funding the warehouse is exposed. Now, here's the bit that makes your head spin. And this is crucial for understanding how Barclays, a massive, regulated high street bank, ended up with around £500 million exposed to a Mayfair bridging lender. The mechanism is called warehouse lending, and it is the bridge, yes, the irony is not lost on me, between the traditional banking system and the shadow system. Okay, here's an analogy so that I can explain it. Imagine you run a fruit stall and you need to buy the fruit before you can sell it, but you don't always have the cash up front. So a wholesaler gives you a credit line. Take what you need, sell it, pay me back. Your stall is the warehouse. That is basically what big banks were doing for lenders like MFS. Barclays and others would set up warehouse structures, little financial containers, and say, here's a revolving line of credit. Go originate your bridging loans, pull them in the warehouse, we'll fund you in the meantime. For the banks, it looked attractive. They were earning fees, earning interest. The lending was supposedly secured on property, and UK property had spent decades making people think it only ever moved in one direction. So what could go wrong? Well, what if that same property had already been pledged to someone else? What if the same house, the same piece of collateral had been used to secure multiple different loans for multiple different lenders at the same time? That is what double pledging means. And according to MFS's accusers, that is exactly what was happening. Double pledging is the fraudulent practice of using the same asset as collateral for multiple separate loans without disclosing this to the lenders. Each lender believes they are secured. In reality, if things collapse, they are all chasing the same asset. Okay, let me explain double pledging in the most relatable way that I can. So imagine you rent your flat out on Airbnb. Fine, normal. Now imagine you rent the same flat to 5 different families on 5 different accounts, all arriving the same weekend. You've collected 5 deposits, 5 booking fees, 5 sets of promises. But there's still only one flat. When those families turn up at the door, there is going to be a problem. That's double pledging. Except Instead of a holiday flat, it's a portfolio of UK property. And instead of Airbnb deposits, it's hundreds of millions of pounds of institutional money. According to court documents, administrators estimated that MFS owed around £1.2 billion to institutional creditors, but the verifiable collateral, roughly £230 million. That is a £930 million hole. If you lend MFS £100 thinking you had £100 of property back in your loan, you might get back 20 pence in the pound. Right, let me introduce you to the cast. So we have Paresh Raja. Paresh Raja built a career in corporate finance. Then in 2006, he and his wife Tiba founded Market Financial Solutions. The pitch was simple: help property investors who couldn't get finance from the high street banks. And for years, that is exactly what they did. MFS grew steadily. They built a reputation for speed and flexibility. Brokers loved them. Need money fast? MFS could do it in 72 hours. Publicly, Raja cultivated the image of a serious businessman with a community profile. MFS sponsored Arjit Singh's debut UK arena concert at Tottenham Hotspur Stadium. Now, if you know who Arjit Singh is, you know that is not a small flex. They were sponsoring Badshah gig in London too. This was not a company trying to stay invisible. And the numbers looked immaculate. As recently as March 2025, they received a clean audit. No qualifications, no going concern warns. The directors signed off that the company had adequate resources to continue in operational existence for the foreseeable future. Record profits, a £2.5 billion loan book, growing fast. But behind the scenes, there were signals. Quiet signals, the sort of signals that only look obvious once everything has already exploded. So the first thing, MFS used a very small accounting firm called Magus, a firm with 2 members of staff, for a £2.5 billion lending book. Professor Paul Barnes, a forensic accounting expert, reportedly called that highly unusual and a clear warning sign. The second thing, MFS and Paresh Raja had already been named in major international money laundering investigations, not after the collapse, before it. Bloomberg, Al Jazeera, The Guardian, The Financial Times, Transparency International all had published reporting connecting MFS-related entities to the financing network behind a huge property portfolio built by Sufaizaman Chowdhury. Who's Sufaizaman Chowdhury? He was Bangladesh's land minister, a close ally of Sheikh Hasina, a man with a declared salary of roughly $13,000 a year. $13,000. And yet, according to published investigations, he acquired approximately 482 overseas properties, 315 in the UK, 142 in Dubai, 22 in the United States. Combined estimate value, roughly £295 million. Bangladesh's constitution requires politicians to declare foreign assets. His were reportedly not declared, and according to Transparency International, 291 out of the 495 financial charges on his UK properties came from MFS-related entities. The UK National Crime Agency froze around £170 million of his UK assets in June 2025, 8 months before the MFS collapse. Now, let me be careful here. I'm not saying that MFS knowingly laundered money. I'm not qualified to make that legal determination. MFS told Al Jazeera it had carried out robust anti-money laundering checks. Paresh Raja categorically denies allegations of fraud. What I am saying is this. There was a lot of smoke for a long time, and the institutions lending hundreds of millions to this firm, the Barclays and the Apollos of this world, were either not looking, not seeing, or not acting on what they saw. Brief note, all allegations in this section reflect court filings and published investigations. Raja has categorically denied fraud. No criminal convictions have been secured. Okay, so fast forward. It's late 2025 and something shifts. In the aftermath of political upheaval in Bangladesh, Chowdhury and his network came under heavier scrutiny. And one detail made investigators stop. In the weeks after Sheikh Hasina's fall, 259 of the 352 MFS-linked loans to Chowdhury were reportedly repaid. 259 loans repaid within weeks from a politician whose accounts had just been frozen. I'll leave that with you. So by 2026, January, Barclays had frozen MFS's accounts. They had detected anomalies, alarm bells were ringing, and then the rats left the ship. By mid-February, every director of MFS except Paresh Raja had resigned. 2 independent directors brought in during 2025, apparently to strengthen governance, both quit within months. Raja's wife, Tiba, an executive director of the company, resigned 4 days before the administration filing. On the 20th of February 2026, MFS applied to enter administration. The reason given, and I love this, a temporary restriction on access to the company's banking facilities arising from a procedural matter with its primary banking provider. A procedural matter with the banking provider. That is one way to describe Barclays freezing your accounts because it thinks something is very, very wrong. So on the 25th of February, Chief Insolvency and Companies Court Judge Nicholas Briggs approved the administration. And what came out in court was extraordinary. Daniel Bayfield, KC, one of the most senior barristers you can get, told the court that Paresh Raja was, quote, under deep suspicion of fraud and had allegedly left for Dubai. The central allegation, double pledging on a massive scale. The same properties pledged collateral for multiple loans from multiple lenders without disclosure. Creditors estimated that MFS owed around £1.2 billion to institutional lenders. The verifiable collateral was about £230 million. That leaves a gap of roughly £930 million. Alex Partners, the administrators, moved in fast. Roughly 156 of the company's 200 staff were dismissed. Worldwide asset freezing orders were pursued, courts in London and Dubai issued orders, a travel ban followed, and the walls of the Mayfair office had already been stripped. The Tyson gloves, the Messi shirt, the Diego shirt, gone. And then the creditors started counting the damage. Barclays, about £500 million. Apollo's Atlas arm, around £400 million. Santander, over £200 million. Jefferies, roughly £100 million. Wells Fargo, Elliott, SMBC, Mercury, an Australian credit fund disclosed $80 million of exposure, which tells you how far these ripples travelled. And all of this came from a Mayfair bridging lender that most people had never heard of. Now, here's the bit that they don't tell you. This doesn't just affect bankers. The MFS story is a case study in what people are calling a regulatory black hole. MFS was supervised for anti-money laundering compliance, but not like a bank, not for its lending model, not for its warehouse structures, not for its collateral management in the way you might assume. It didn't take retail deposits, so it sat outside the part of the system people instinctively think of as core banking regulation. It sat in a gap between the regulated banking system and the void, and it borrowed £2.5 billion while sitting there. One of the things that we have to ask is, what does this say about due diligence? Barclays is one of the most sophisticated financial institutions in the world. So is Apollo, so is Santander. These firms have armies of risk managers, lawyers, compliance teams, and yet they lent hundreds of millions to a company whose auditor had 2 members of staff, and which had already been named in major investigative reporting. Santander's executive chair, Anna Botin, reportedly compared recent private credit losses to jellyfish stings. Painful, sudden, and possibly a sign of a much larger swarm. And final thing, this is not just a city story. MFS was lending into the real UK property market, to buy-to-let landlords, to projects that affect real buildings, real tenants, real local economies. The collapse doesn't just hit Barclays shareholders, it hits brokers who place clients with MFS, developers waiting for drawdowns that will never come, properties stuck in administration, projects that stall, jobs that disappear, and then there's the Bank of England. Within days of the collapse, the PRA reportedly sent letters to major banks with exposure to MFS, not as a box-ticking exercise, as a genuine question. How did you lend this money without catching this? Right, let's bring it home with a quick recap. So, shadow banking, the vast, fast, flexible world of lending that operates outside traditional banks. Not small, not fringe, systemically important. Bridging loans, short-term, high-interest property finance for when time matters more than price. Useful, legitimate, but risky when scaled. And warehouse lending, the mechanism that lets big banks feed money into the shadow system. This is how the regulated world and the unregulated world touch. And then we have double pledging, using the same property as collateral for multiple loans without telling the lenders. One flat, 5 bookings, everybody thinks they're covered, nobody is. And market financial solutions. A £2.5 billion Mayfair lending empire, a £930 million hole in the collateral, a founder accused of serious fraud and alleged to have gone to Dubai, and a collapse that forced some of the biggest institutions in finance to ask a very simple, very embarrassing question. How did we not see this? And this is why I always say the real action in finance is never where they tell you it is. It's not just the banks, it's the system growing around them. And if you've watched the first episode on distressed debt, you can probably already see the pattern. A lot of the risk now lives in places that move like banks, but aren't treated like banks. If you want more of this, I'm on TikTok and Instagram, same name, breaking these stories down as they happen. And if you rate what I'm doing and you want to support it, you can buy me a coffee, the link's below. That helps me keep going, keep digging, and keep explaining this madness properly. I've read the news so that you don't have to. I'll see you next week.